This week, we're going to break down ETFs with our investment expert, VP of Financial Education at Squire, Casey Halliley, in 5 minutes or less, which is going to be incredible. So let's start the clock and get going. So what is an ETF?
ETF stands for Exchange Traded Fund. So you can think of an ETF like a basket of stocks. And there are lots and lots of different financial products out there that ETFs cover. But to simplify today, I'm just going to talk about stocks. Sometimes ETFs are called index funds. And I just want to take a really quick second to differentiate between an index and a fund. An index is a basket of stocks you might refer to see what the market is doing at a given time. A fund is something that you buy. An ETF is an index fund. So let me explain what I mean by that. Let's talk about the S&P 500 for a second, which a lot of people have heard of. That is an index of 500 American stocks. So when people say, what's the market doing? They might look at the S&P 500 to see if it's up or down for the day or the month or the year. But if they want to buy the S&P 500, they need to buy an ETF that tracks that index. So an ETF is an index fund. It is a fund that tracks an index. It's also a way to buy all of the stocks in that index in one fell swoop, instead of buying, in the case of the S&P 500, buying 500 individual stocks. So ETFs will typically track any type of index, like a sector index, like retail stocks or energy, or they can track broad indices like the S&P 500 or the NASDAQ or the Dow, or they can track foreign indices like the FTSE or the Nikkei in England or Japan, or they can track other financial products like bonds, commodities, or currencies. But as I mentioned today, we're just going to talk about stock ETFs. But there are tons of indexes and there are thousands of ETFs that track them out there. And also, just to complicate things further, there are a bunch of different companies that create and manage ETFs. So there are several different ETFs that track the S&P 500. At its most basic level, an ETF is a fund that you can buy that gives you exposure to a lot of different stocks all at once.
That was awesome. So ETF is kind of an index fund, right? How is it different than the mutual funds? Because I think there's index mutual funds as well.
Yeah, ETFs and mutual funds are very similar and they're also quite different. So they're both funds and they both allow you to buy a big group of stocks all at one time. But they're different in two important ways. Number one, ETFs usually track an index, as I mentioned, and indexes don't usually change, or they change very infrequently. So because of that, ETFs are usually called passive or unmanaged funds because they just simply track the index, whereas a mutual fund is usually managed by a team of people who are trying to decide which stocks to buy and sell so that they can beat the index. So a retail stock ETF will track or mimic the retail index, and a retail stock mutual fund will try to beat that retail index. So this is not always the case that ETFs are only index and mutual funds are only managed, but for the most part, that's true. So that's the one way that ETFs are different from mutual funds. And the second way is that ETFs are bought and sold throughout the day on stock exchanges, whereas mutual funds are typically traded only once per day at the end of the day at a specific price and a specific time. So the mutual fund company will pick the price at the end of the day, and anybody that wants to trade that mutual fund during that day will buy and or sell, execute that trade at the exact same price. So an ETF is an exchange traded fund. So they're traded on the exchange.
Now we know the difference between a mutual fund and ETF fund. Are ETFs cost effective? Are they cheaper? Are they more expensive? How does the cost play into this?
That's a great question. So because ETFs are typically unmanaged, they are managed by a computer. So basically they track an index and a computer does almost all of the work. They're perhaps the cheapest way to buy a diverse portfolio of stocks. So it's much cheaper to buy the S&P 500 ETF than to buy 500 individual stocks and paying commission on each one of those trades. Not to mention, of course, all the time that you would spend doing that. ETFs are super cost effective.
Which really goes into then you making more money because your returns could potentially be better because you're not paying commissions or trade costs. What are the pros and cons of ETFs?
There's lots of pros, not a ton of cons. Some of the pros of ETFs are, first and foremost, they provide you with a lot of diversity. They allow you to buy a lot of different stocks at one time. Another pro is that they are very, very easy to trade. You can trade them all day long as the market is open, as I mentioned. They're also very liquid, typically in normal market conditions. That you can get in and out of them and trade large amounts if you need to. They're very cost effective, as I mentioned, and there are tons of ETFs, and they focus on really targeted industries. So if you're interested in buying Japanese retail stocks, you can find an ETF that tracks that index. And lastly, I would say there is no minimum investment required. So you don't need thousands of dollars to start investing in an ETF. You only need enough money to cover the price of one share, which can generally range from somewhere between $25 and a few $100s. So those are some of the pros. And some of the cons of ETFs is most ETFs are passive and unmanaged. There are managed ETFs, and they can be a little bit more costly. So you have to check the fees on those. And although ETFs give you a lot of diversity, they give you diversity within a sector. So if you buy a retail ETF, you have a lot of diversity within retail. But if that's all you buy, you don't have a lot of diversity within the whole entire market. So they give you diversification within an industry, but not necessarily whole market diversification. So just a few quick fun facts on ETFs. Half of ETFs are priced between $20 and $50. So that means if you wanted to start investing and you want exposure to a segment of the market, you could potentially do that right now for as low as $20. Also, the most heavily traded ETF is the ETF that tracks the S&P 500. The ticker for that is SPY. Also, there are three main companies that handle more than 80% of all of the ETF activity in our country. BlackRock, their ETFs are called iShares. State Street, their ETFs are called SPDRs, and Vanguard. And I'm sure you've heard of most of those companies. And then lastly, if you want to sound like you know what you're talking about, you can call the S&P 500 ETF. The ticker is SPY. You can call them the spiders. If you want to talk about the Dow Jones Industrial Average ETF, the ticker for that is DIA. You can call that the diamonds. And the NASDAQ ETF, the ticker is QQQ, and you can call that the cubes or the triple Qs.
Thanks for tuning in to another episode of the More Than Money podcast. If you feel like you learned something or enjoyed this episode today, we ask you to do a few things. Number one, leave us a 5-star rating and a review on whatever platform you're listening to. If there's something you're struggling with and want us to cover, let us know in your review and we'll make sure to cover it soon. Second, make sure to follow Squire on social media and share this podcast with any workers, employees, or friends. This podcast is made possible by Squire, customized financial wellness program that will help you create a culture of care with happier and healthier employees day in and out. Whether you're a business owner, HR manager, or just someone trying to live your best life, Squire is for you. Head over to squire.com to learn more about how Squire can transform your workforce. And that's squire.com.